Welcome back to the Deep Dive. If you're trying to get a clear map of where the economy is headed right now, you have definitely come to the right place. You can just feel the tension in the economic air right now, can't you?
Oh, absolutely. It's completely charged.
We're sitting at this massive pressure point. You've got this key Federal Reserve rate decision. The third cut this year, by the way.
And one that was far from unanimous.
Exactly. And it drops right into a job market that's sending out signals so confusing they might as well be encrypted.
It's the ultimate puzzle, really.
That's the knot we're diving into today.
Yeah.
You shared a stack of sources that they really highlight how tough it is to read the tea leaves right now.
It seems like every significant number we look at comes with this giant asterisk next to it. And every move the Fed makes splits the board right down the middle.
It really suggests an economy in a state of, rapid, uncertain transition.
I think that's the perfect way to put it.
So our mission here is to try and isolate the signal from all that noise. We're going to dissect this Fed rate cut, and then we have to meticulously filter through this really volatile labor market data from September and October.
The job openings, the hiring shifts.
The messy claims numbers. We're here to bring you that clarity, those aha moments, and cut through the headlines.
And we really have to navigate that non-unanimous nature you mentioned. I mean, if the most informed economists are disagreeing this much,
right,
it means there's a deep fundamental nuance that you have to understand before you can even start to form an opinion.
Okay, well, let's unpack this. Let's start with the big action. The Fed cut the Fed funds rate. This is the move that impacts all of us. Can you lay out the specifics?
Sure. The Federal Open Market Committee went with a very targeted 25 basis point cut.
Okay.
And what this does is it shifts the new target range for that rate to between 3.5 and 3.75%.
Right. And we hear basis points all the time, but let's just clarify. The Fed funds rate, that's just what banks charge each other for overnight loans, correct?
That's the technical definition, yes.
So why does 0.25% in that one specific rate matter to someone, applying for a car loan tomorrow?
That's the crux of central banking power. While it is just the overnight bank lending rate, you have to think of it as the fundamental benchmark for the price of money across the entire U.S. financial system.
It's like the gravitational center.
Exactly. A perfect analogy. When the Fed moves that target, even by 25 basis points, that decision just ripples outward.
So lenders see that and adjust accordingly.
They do. They use that rate to set their own prime rates, and those rates directly influence the cost of borrowing for, almost everything.
Mortgages, business loans.
30-year fixed mortgages, commercial lines of credit, the interest rate on that new car loan you might get next month, it all connects back.
So that small movement could, maybe just marginally, relieve some of the pressure on consumer debt.
It could. It's the highest magnitude ripple effect. But this is where we get into the internal drama.
The lack of consensus.
Right, this cut was not a unified front. And when you see a split like this in a Fed decision, it's a direct window into their internal battle over what the priority should be.
So what was this three-way conflict?
It was extremely pronounced. On one side, you had Governor Stephen Mnuchin, who argued for a much larger, more aggressive cut.
How much larger?
50 basis points. Double what they ended up doing.
Wow, a 50 basis point cut is a statement. What does that kind of aggressive push tell us he's seeing?
It tells us he sees the risk of an economic downturn or maybe a job market collapse as the far greater threat right now, much bigger than inflation.
So he's looking at the cooling signs and getting worried.
He's looking at forward indicators and likely concluding that the economy is slowing down faster than the consensus admits, and he thinks the Fed risks a recession by staying too tight.
But then, on the complete other side of the ledger, you had people who didn't want to cut at all.
That's right. At the opposite extreme, you had Jeffrey Schmidt from Kansas City and Austin Goolsbee from Chicago. They wanted to keep rates entirely unchanged.
Meaning they're still prioritizing the inflation fight above everything else.
That's the critical tension. This split, this three-way split, it just nails the central challenge Chair Powell is facing. He has to balance this persistent, stubborn inflation against clear evidence the job market is cooling.
It's a high-wire act.
It is. The slightest move in either direction risks a major policy error.
And so the 25 basis point move becomes the middle ground, the compromise. How did Chair Powell frame that?
He was very cautious. He basically acknowledged all the uncertainty, saying there's no risk-free path forward.
Which feels pretty honest right now.
I think so. The 25 points was the move that preserved their options. It signals, some confidence that inflation is moving the right way, but it also provides a little stimulus to ease that cooling.
And critically, it buys them time.
It buys them time. It signals they're waiting for clear, unambiguous evidence from the data before they commit to anything else.
And that need for clarity brings us right to the data they're wrestling with, the labor market.
If the Fed is waiting for clear evidence, the job market has definitely not been providing it.
Okay, so we've set up the compromise at the Fed. Now let's look at the data that makes that compromise so necessary, starting with that flashy headline number for job openings. What do the sources report?
The sources noted a pretty unexpected increase in job openings. The data for September and October showed them rising from about 7.23 million up to 7.67 million.
On the surface, that looks like robust demand is still there.
It does. If you stopped reading right there, you'd think the labor market is surging again.
But this is where we need that crucial caveat. What's potentially inflating that 7.67 million figure?
What's so fascinating is how our modern work structures are creating these statistical artifacts. That headline number may be artificially inflated because of how remote jobs get posted. Companies often list the exact same remote job opening in multiple states.
Dozens of states sometimes.
Exactly, dozens. To satisfy hiring rules or just to get more eyeballs on it, and this practice boosts the total count without actually reflecting dozens of unique jobs.
That's a vital piece of context. So It's not 7.5 million distinct open positions.
It's 7.5 million postings. It's a data distortion caused by the digital nature of how we hire now.
Okay. And what about the bigger picture?
Well, even if we take that recent bump at face value, we have to remember where we were. Even at 7.67 million, openings are way, way below the historic peak we saw in 2022.
When they were over 12 million.
Soaring above 12 million. So relative to the recent past, the overall demand has cooled off substantially. The market is definitely running cooler.
Resilient, maybe, but certainly less frenetic than it was 18 months ago.
A good way to put it.
This moves us from the raw opening count to the really telling metrics, the softening under the surface. This is what tells us how eager employers actually are to hire people.
Right. If you look beyond just the number of job postings, the picture gets a lot clearer, and it points almost uniformly toward, let's say, reduced enthusiasm for hiring.
So what are those specific non-headline metrics telling us?
We can look at the hiring rate, the quit rate, and the layoff rate. And all three of them are slowing down.
The hiring rate is slowing, which suggests companies are just taking longer to fill jobs.
They're taking longer, maybe waiting for more clarity on the next quarter before they commit to new payroll costs.
Let's focus on the quit rate, because that feels like a pure psychological metric. It tells us how many people feel confident enough to jump ship for something better.
It's a great indicator of worker leverage.
So if that rate is slowing, what does that imply?
It implies a pretty significant shift in power. Fewer people feel confident enough to risk leaving a stable job. They're choosing stability, holding on to what they have, instead of aggressively searching for better pay.
Which would mean less wage competition.
Diminishing leverage for workers, slower wage competition, all hallmarks of a cooling labor market. And it completely contradicts the story told by that flashy job openings headline.
So the underlying movement really supports the cooling thesis, the one Governor Marin was worried about.
Absolutely. The market is decelerating, even if it hasn't, fallen off a cliff.
This all sets the stage for the most confusing part of the data stack, the jobless claims. They're supposed to be a real-time indicator, but lately they've been just so unreliable.
This is where the short-term calendar noise really starts to mask the signal. Let's look at initial claims first, people filing for the very first time.
Okay.
The numbers showed a sharp rise of 44,000, hitting 236,000. That sounds like a sudden problem.
It sounds like employers suddenly hit the panic button.
It does. But here's the twist. That sharp increase came right after an unusually low Thanksgiving week. Think about the mechanics. State offices might be closed, or people just delay filing because of the holiday. The next week, they all file, and the number spikes. It's statistical noise.
So it's more likely an artifact of people catching up on filings, not a sudden collapse in the job market.
That's what the analysis suggests, yes.
Yeah.
It's more about administrative timing.
Okay, so what about the other side? Continuing claims, these are people already getting benefits. Those dropped sharply, which should be good news, right? It means people are finding jobs.
That's the logical conclusion, but it's often misleading. This is the second critical twist here.
Okay.
The analysis shows this drop was likely driven by short-term structural factors, not a wave of people finding new jobs. We see holiday disruptions again, but more importantly, we see the timing of benefit expirations.
So people are dropping off the unemployment rolls not because they got a job.
But because their eligibility for state benefits just timed out.
I see.
Exactly. When people exhaust their benefits, the continuing claims number drops, and the headline looks like an improvement. But if unemployment is dragging on long enough for people to exhaust their benefits,
It actually suggests a continued softness in the market for that group of people.
it masks the true duration of unemployment for a large cohort.
So even the Fed can't escape the tyranny of the Thanksgiving calendar and state benefit laws.
It makes their job almost impossible. The synthesis here is clear. The current claims data is extraordinarily difficult to interpret. These short-term factors are actively masking the real economic direction.
You just can't look at it and say with certainty the job market is getting better.
You can't. It just reinforces the intense ambiguity the Fed is dealing with.
Which brings us full circle, back to our core challenge.
Yeah.
The difficulty the Fed had reaching a consensus on that cut, it perfectly mirrors the chaos in the data they're getting.
It's a perfect mirror. You have a slight bump in openings, which is encouraging for some.
But then you have the clear cooling in hiring and quitting, which worries others.
And finally, you have this incredibly volatile claims data driven by all these confounding effects. It's an economy defined by conflicting signals.
So what does this all mean for policy going forward?
Well, the path ahead is it's completely unclear. It reinforces what Chair Powell said. There's no risk-free path.
Any big, decisive action, a dramatic cut, or a prolonged hold is just fraught with risk right now.
It is. The risk is acting decisively on structurally misleading data. It means this moment demands patience, even if patience feels really uncomfortable.
And for you listening at home, what's the big takeaway thought?
Here's a provocative thought to mull over. As you see future headlines, consider how much of today's perceived stability, that job opening number, or the drop in continuing claims, might just be an illusion.
An illusion created by things like remote jobs being posted everywhere.
Or temporary factors, like benefits expiring on a rigid calendar. If that stability is just an illusion of how we present the data, what does that imply for the Fed's future decisions?
Which are based on filtering this exact noise.
It raises a huge question about whether our traditional metrics can even accurately capture the speed of economic change anymore.
Something to keep thinking about. Thank you for joining us as we sorted through all this complexity. We hope this has provided some clarity on the Fed's tough position and the real story behind those numbers.